Welcome to Kitco News. I'm Niels Christensen. Joining us today is Axel Merk, President and Chief Investment Officer of Merk Investments. Thank you very much for joining us today, Axel.
Great to be with you, Niels.
Excellent. So Wednesday, we heard Federal Reserve Chair Jerome Powell say deficits don't matter. What does this do for financial markets? I mean, we're in such unprecedented waters. What's your take on what he said?
Well, I mean, there's going to be free money for a long, long period, and obviously, what it does on a abstract level, it distorts the capital allocation process. Right, the businesses that should go bust don't go bust, and for a good reason. I mean, we don't want most of the business go bust right now, but let's not kid ourselves. There's not going to be a free lunch. And Kaplan, today we're speaking on Friday, have said that that there needs to be more. And this is right now the Fed is providing relief, but we also need stimulus, right? And so this is only the first or second inning of what we're seeing here. Usually when you have a shock in economy, that is deflationary. The reason why things might turn inflationary is because of the policy reaction to the bust.
Okay, this inflation deflation story. Do you think is that what we focus on? I mean, do we focus on the short-term deflationary shocks in that, we saw GDP, Q1 GDP fall 4.8% this week. Obviously there are deflationary pressures, but with all the money sort of sloshing around the system, like you say, there's probably going to be more. Is it more important to focus on the inflationary risks?
Well, there are a couple of different topics here. The thing I would first focus on is inflation expectations. And that sounds like an abstract term, but as many are aware that over the last couple of decades, inflation had gradually been trending down. There had been some rise in wage pressures before this bust. But what can happen is with the floor kind of falling out from underneath us, is that certain prices will be plunging. And that might unanchor inflation expectations on the downside briefly, but then it's more dangerous for the market, so to speak, when certain things go on the upside, because then we don't have that anchor anymore, and that's when things could get a little dicey. Even Bernanke, when he asked about what's going to happen, he hedges his bet whether there's going to be inflation at the other end of it. Now, just a word on inflation more broadly. When inflation does come, it's not like the overall price level is just going to rise uniformly. What we see historically when inflation picks up, it hits us in different spots. And we see some of that, of course, that masks get more expensive, toilet paper is in short supply, and maybe prices go up, right, get rationed. And I'm not suggesting that's the first kind of warning sign that inflation is going to break out. But even when inflation does come more broadly, we'll see it in all kinds of bits and pieces, and we'll shrug it off. Because it's isolated, right? And then sooner rather than later, it's gonna come around more, and that's usually why then policymakers get caught off guard. The other thing also, to expand even more, is people are wondering why didn't we have inflation after the financial crisis? As well, the Obama stimulus wasn't all that inflationary. A corporate tax cut is indirectly inflationary, meaning that over time, sure, there might be wage pressures, but now we're considering an infrastructure stimulus. We may actually get money to a place where inflation will come. We're going to give money to people that are actually going to spend it. If only the 1% make the money and don't spend it, that's not going to translate to retail inflation. But so the type of stimulus we're expecting, I think, is going to be far more inflationary than anything we'd seen in the previous cycle.
And I guess so like let's sort of tie this into gold. I mean, what are your expectations for gold in this environment? I mean, we've seen a pretty good bounce off of the March lows. People are talking about all-time highs. People are talking about $3,000 gold in 18 months. Is the price sort of secondary to the trajectory?
Well, first, the volatility is there because people love to trade gold, and when there's something happening, people jump in and out, and that then attracts more people. Gold is one of the few diversifiers that's proven over time. In the sense that the correlation is near zero over time. And so if you don't know what the hell the market is going to do, it's something to look at. In every bear market since the early 70s, gold has performed extraordinarily well, with the exception of when real interest rates were moved very high by Volcker in the early 80s. And so there are some good reasons. Ultimately, gold, a brick doesn't pay dividend. And so if you get compensated for holding cash um, with real rates, a real return, then you don't want to have gold. But if real rates are going to be very low, then yes, there is a good reason to hold gold. And let's not forget, aside from these inflationary fears, the incentive to socialize all this money spending means that inflation is really in the interest of governments. And so I would just not fight the governments here. And yes, gold is not going to go up every day, especially when you're already at the zero lower bound. For interest rates, real rates are not always going to go down. You're going to have some quirks there with bonds moving, and I'm mostly talking about the 10-year here. That will cause a rocky ride here. But yes, when push comes to shove, I'd rather own gold in the medium term than many other things.
Turning back to the Fed, do you think they still have ammunition left? I mean, have they done all they can? Is it now up to governments? I mean, we heard Christine Lagarde sort of say that on Thursday. There needs to be some fiscal coordination in Europe. So I'm sort of wondering, do you think central banks are worried that they are running out of ammunition?
They always have ammunition, maybe not the right ammunition. The one thing, in the peak of the panic in March, people were scrambling for dollars. The Fed cannot create more treasuries. What they can provide is liquidity. And so historically anyway, and so that's why they can put some oil into the system. But the way, if you ask whether they have more ammunition, they could declare more assets, safe assets. And so the ECB is declaring Greek assets safe, right? And so with that, they can do more. You can declare junk bonds safe. I mean, the Federal Reserve is now buying junk bond ETFs, so it's able to buy them. And so, yes, they can always do more by expanding what they declare as a safe asset, because then you can, quote unquote, flee into those assets, and they're as good as treasuries. I'm not suggesting junk bonds are as good as treasuries, but that's the sort of thing a Fed can do. So they can always do more. Now, is it going to be effective? Obviously, a Fed cannot cure a virus. And ultimately, yes, there needs to be a fiscal response. But it seems like we have a happy family in Washington these days that is more than happy and willing to spend money. Some of that happiness might erode, but it does appear there's an appetite on both sides for some infrastructure spending bill.
Well, and it does feel like we're sort of entering an experiment. Everybody who's sort of talked about modern monetary theory, it seems like now they're trying to implement that. And I'm sort of, like, it does. It feels like, this experiment is just going to get bigger and bigger. Like we're just on the cusp of, deficits don't matter kind of thing.
I think we haven't seen anything yet. I mean, just think about it. We have shown that we can spend trillions, and look, there's no inflation, right? So if you're a politician, hey, why not spend a few trillion more on, and we're not talking billions, trillions, right, on my pet project? The Fed is going to print it, is work with the government, it's this and that. And so let's not forget, I am all for taking emergency measures if and when needed, but let's also not forget that we are setting precedent, right? The '08 tools kind of were pulled out and deployed within minutes, so to speak. And so similarly, we're doing more and more. And the government is just getting the taste of what it's like to spend money. And anybody else, I think, by now knows that the V-shaped recovery is a bit of an illusion. And so that means there's going to be a lot of support being given. And that support is going to be given where people are going to spend it. And so, yes, this problem that people had, that they call the problem of inflation being too low, I think is going to be taken care of by that. Maybe not tomorrow, but and let's not forget, you asked about the price of gold, right? People don't buy gold because there is inflation. They buy gold because of the fear of inflation, right? Markets are forward-looking, and similarly, the buyer of gold. So it's about the threat of something. As long as there is the threat that government is going to do stupid stuff, I think there's going to be a buy of gold. Unless you tell me that suddenly everybody has gotten sane in Washington.
Well, I mean, it's not just Washington; it's also equity markets as well. I mean, I think we understand that we're not going to see a V-shaped recovery, but equity markets don't reflect that, and it feels like with all of this money sort of sloshing around, we can ignore risk. And I think, that's one of the things that you and I have talked about a lot is, this compression of risk. And it does feel like that's happening, and now just at a bigger scale.
Yeah, well, you talk about experiment. I mean, ultimately, none of us have a clue, right? It has never happened in the US that we've had both a supply and a demand shock of this magnitude at the same time. We're spending and printing an unprecedented amount of money in extraordinary time. Will that inflate asset prices? Or are the economic fundamentals more important? That some airlines, one of the European discount airlines said they're not going to restart flying until next summer because the winter isn't profitable anyway, and so forth, right? And the shutdowns are longer and longer. And we now had some big tech companies saying, oh, maybe we do have some issues after all, right? Does that matter or not? And the only thing I can tell you, let the market be up for a day and you're going to read stories about how everything is great. Let the market be down for 2 days. And you'll see how everything is miserable. So the journalists will fit the story. Ultimately, of course, we have to make forward-looking investment decisions. And what I tell people, we can't give specific investment advice, stick to your process, right? If you're a day trader, be my guest. If you're a long-term investor that rebalances, consider doing that. And at the same time, if I look at these valuations, one of the things that's happening in this market is that it needs much less flow to move prices. Some studies have shown in 96, I think, was the last time it needed so little money to move kind of a point in the S&P. And so this isn't everybody jumping in. Now, the backdrop is, of course, we had 2009, and for years people didn't believe in the rally. So what am I to tell you that we're going to go back down? But in 1929, we didn't hit the lows until 1932, right? And so retested that low. So anything is really there. And similarly gold, right? I like gold, but gold is notoriously volatile. There can be a day when it's down several percentage points, and so with any of these things, you need to have a plan of exactly how do you want to be in these markets. And sometimes it's best to maybe just turn off the screen and, of course, not Kitco, but everything else, and just stick to kind of the sort of plan that you have.
Fantastic advice, Axel. This has been a fantastic conversation. As always, I enjoy talking with you so much, and I always learn so much. So thank you very much.
Yeah, well, stay safe there and have a great day.
Thank you very much for watching Kitco News. For the latest in the precious metals information, go to kitco.com. Thank you very much. Stay safe and stay healthy.